Today, nearly 90% of retail traders in the stock market rely on option buying because of their limited capital. So, in this video, we'll explore how to take precise entries on major indices within a 3-minute time frame, focusing specifically on option buying setups. You can also apply this as a scalping strategy. But before we dive in, if you find this content valuable, make sure to hit that like button. And if you're new here, don't forget to subscribe and enable notifications so you never miss any of our latest updates. I'll catch you right after the intro and disclaimer. In this strategy, our primary focus will be on price action. However, to confirm our trade entries, we'll use the swing trade signal indicator alongside price action to capture as many points as possible from the market. So, let's dive into the details. This is the 3-minute time frame chart of an index. As soon as the session begins, the price attempts to move upward but faces rejection at higher levels and drops. Then, after taking support from the lower zone, the price once again tries to break its intraday high but fails. On the decline, a strong bearish trend starts forming. When a momentum candle breaks its previous swing low, sellers in the market get fully exposed through this price action, and we can say control has shifted to them. This indicates a potential short setup based purely on price action. To confirm this short entry, we'll apply the swing trade signals indicator to the chart, which is based on a simple moving average. The second time, the price closes below this indicator. When the price trades above this line, it appears green, showing bullish sentiment. Once the price closes below it, the line turns red, signaling a bearish bias. According to the price action, the market has broken its prior swing low and is currently trading below the indicator, suggesting a higher probability of a bearish continuation. After confirmation from both the indicator and price action, we can enter a short position with our stop loss placed above the high of this red candle. Once the price reaches our 1-to-2 risk to reward ratio, we can secure 80% of the profits and hold the rest for an extended target. If trading with a single lot, the entire position can be exited here for a full profit. Later, when the price finds support and attempts to rise above the indicator, that's the cue to close the remaining quantity. The price consolidates above the indicator for a while, forming a bullish price structure. Notice that the green candles are larger than the red ones, and the swing low remains unbroken. Now, if we use the Fibonacci tool from the recent swing high to swing low, the price repeatedly hovers around the 0.50 level. This means a bullish candle closing above that level could indicate a potential reversal. A little later, a bullish candle does close above the 0.50 level. By placing a stop loss just below that candle's low, we can plan a reversal trade here. This bullish candle triggers multiple stop losses of sellers in one go. With those sellers now out of the market, their stop losses provide the liquidity required for the market to move upward. Since we've already booked profits from our previous trade, even if this stop loss gets hit, our overall gains remain positive, and we don't risk our own capital. Once we enter this trade, we can set the swing high as our target, and the price quickly reaches it. The market continues to form higher highs while taking support near the indicator line, moving steadily upward. Therefore, we can hold this position until the price closes below the indicator. By adjusting our trailing stop loss upward, we can capture the entire upward momentum. Let's move on to the next example. This is the 3-minute time frame chart of a leading index. As soon as the market opens, the price moves within a narrow range, forming a symmetric triangle pattern on the chart, which later breaks with a strong bullish candle. The price is trading above our indicator here, and since the market has broken the triangle pattern with a bullish move, this is a strong bullish signal according to price action. However, we should not enter a long position solely based on this breakout. Before taking a trade, it's crucial to analyze the market psychology. The market has opened with a gap up of nearly 400 points from the previous session's close. This means traders who had already taken long positions in the previous session have gained good profits due to the gap up opening. Additionally, there's a psychological resistance level at higher levels, just 130 points away from our entry zone. This implies that entering a long trade here would offer a smaller profit target compared to the stop loss, resulting in a weak risk-to-reward ratio of around 1 to 1.5, which is not favorable. Furthermore, when the market opens with a gap up, it often tends to fill that gap later, increasing the chances of a downward retracement. Hence, we should avoid entering this trade. After some time, the market rises but faces rejection from the resistance level and moves downward, creating a fresh price structure. Drawing a trend line from recent highs and lows reveals a clear downtrend forming again, indicating renewed selling pressure. The price continues forming lower lows, showing that sellers are active. If the price breaks the low of the last bullish candle and closes below the trend line, confirming a breakout from this triangle pattern, we can plan a short setup here. Shortly after, a bearish candle appears near the trend line and attempts to push lower. Buyers try to defend by pushing the price up, forming a long lower wick, but they fail to close the candle within the trend line. This indicates sellers have full control. We can now take a short trade by placing the stop loss slightly above the trend line and targeting at least a 1-to-2 reward ratio. After some time, the price moves down, hits our target, and consolidates within this range for the rest of the session. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this October 10th. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500 plus 61% off for pre-bookings before October 10th. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. Let's move to the third example. This is a 3-minute time frame chart of another major index. The market opened slightly gapped down from the previous close, and the price immediately shows a strong bearish trend. A large momentum candle appears, but we cannot enter a short trade here because of its oversized range. The stop loss would be too large. At this point, the price is far below our indicator line, which represents the average market price over the last 17 sessions. This suggests the price may soon pull back toward its mean level. If the price climbs to retest its intraday high and forms a bearish structure below the indicator, we can plan a short entry with a smaller stop loss. The price rises from lower levels but faces rejection near its daily high. However, the candle here doesn't close lower. Instead, it forms a dragonfly doji pattern, a strong bullish signal. Sellers who shorted near the highs are now trapped as the next bullish candle breaks the previous swing high. The price is trading above the average line, so we can plan a long trade setup here. Although a psychological resistance exists near 22,000, we still consider a long entry. You might wonder why we're going long despite this resistance. To understand, let's review the previous day's price action. On the 3-minute chart, the price crossed above the 22,000 level but was pushed down again by sellers. Buyers, however, continued to push back, causing multiple breakouts and rejections near this level. This shows that neither buyers nor sellers have full control around 22,000, meaning it's not a valid resistance level. As soon as we enter the long position with a stop loss below the bullish candle, the price breaks past the 22,000 zone and gradually rises. Once the market achieves a 1-to-2 risk-to-reward ratio, we can book 80% of our profits and hold the remaining position for a larger move. Now that we've understood all 3 examples, let's discuss some key points about this strategy. Point number 1, do not take any entry unless a valid price action setup forms on the chart. Never rely solely on the indicator. Point number 2, this indicator should be used strictly for confirmation purposes, not as the primary entry trigger. Point number 3, since this indicator functions on a simple moving average, when the price moves too far from it, avoid trading until it retraces near the line. Point number 4, if the price breaks the indicator with a large Marubozu or momentum candle, skip the trade. Such breakouts often lead to reversals. Point number 5, when the price keeps hovering near the indicator with small candles, avoid trading until a major level breaks. Point number 6, always follow strict risk management when combining this indicator with price action. If a setup doesn't meet your risk rules, do not trade it. Lastly, every trader watching this should backtest the strategy on multiple charts. Each trader has a unique mindset and trading approach, and the strategy must align with your personal style before applying it in live markets. That's it, traders. Thanks for watching this video. Every setback is just the start of your comeback. If this video reignited your drive to move forward, drop a like to show your support. And if you're new around here, don't forget to subscribe and tap the bell icon so you never miss an update. Keep striving, keep growing, and keep getting stronger. I'll see you in the next video.